Hey guys, John Paulamy here, Actionable Intelligence Alert. Today is Saturday, March 28th, 2020, and this is the weekly market update. So, in this week's reality check, obviously, there was quite a bit of news this week. Basically, coronavirus infections continue to increase. Again, we really don't know where this is going to end up. You can follow various websites that do the tracking, and in some places in Asia, we've seen, because of the stringent social distancing and testing regimes that have been put in place in places like South Korea, we begin to see things roll over. We're hopeful that that happens in the US and in Europe. However, what I want to focus on this week is the response, because we started seeing the response to this lockdowns and economic conditions and toll that's taking place. I mean, obviously the human toll is bad. People are dying, people are suffering, but this video blog series focuses on economics and the markets. So one of the things I've been curious about is, what was the federal government's response going to be? We've begun to see that response, and you can see here, for example, this is from the St. Louis Fred web section of the St. Louis Fred, where they do all of the data collection. You can look up these charts yourself. You can look up these things. A very good tool for checking all kinds of economic statistics if you're interested, from all types of. You can adjust the data sets, the time frames, the whole shebang. So if you're interested in doing that kind of stuff, you can do it. But what I wanted to point out here is the total assets of the Federal Reserve's balance sheet. And you can see, I only took this back to earlier in 2018, but you can see it was in decline. And then we had the issues with the repo crisis and now the coronavirus. And you can see how the Fed's balance sheet is basically going, it's crossed $5 trillion now. So it's basically increased by about, 25% in the space of a couple months. And this is going to go a lot higher. We don't know how long that these shelter-in-place directives are going to last. We don't know the true economic impact. We don't know what exactly is going to happen. So we do know that politicians don't like to be seen as doing nothing. And we do know that there's this propensity to think that you can just print money out of thin air. And we'll get into that. There's some excellent information I had from an article by Jim Bianco this week that talks about all the schemes that they're cooking up at the Treasury Department and in the federal government. This is the initial claims for unemployment. You can see that they've soared. I don't know if you can see this, how well it translates in the video, but basically initial claims are running under 400,000 a week. I took this back to 2017 just for illustrative purposes. But you can see just in the last week, this has soared. This is the greatest increase in first-time unemployment claims in history. I suspect this is going to continue higher over the ensuing weeks as more and more people are laid off. And, now we're going to see the federal deficit explode because you have, economic stabilizers that go into effect once you get into these recessions or once you get into these scenarios where, you have mass unemployment. Unemployment insurance, food stamps, Medicaid, all this stuff is going to, there's an expectation we have these safety nets. We're already running trillion-dollar deficits, and now we're going to see the deficits explode. And like I said, there's all kinds of things being thought up in Congress and by the president going forward to counter the deflationary effects of shutting, large swaths of the economy down. So the question I have to ask is the cure worse than the disease? Somebody called me the other day and said, what do you think is going to happen? And I've been pondering this. There's various scenarios. you can play a lot of what if, and we really don't know. What we do know is that the federal government is going to step up and try to plug the gap, the output gap that's happening with large parts of the economy being shut down. I mean, restaurants, bars, sporting events, large gatherings, conventions, conferences, all this stuff has gone away. So your travel and leisure, your restaurants, your eating out, that's all over with. I mean, and I'm seeing, different news articles, mass layoffs. I'm involved in a business in California that serves food, and it's in a high traffic area, i.e. Venice Beach, and we've had to shut down, and we don't know when we're going to open. We don't know if the business is going to be able to continue. We make most of our money in the summer during the tourist season. You get 15 million people a year going down Venice Beach, and we get a large portion of those folks to come into our place. But with no traffic and no idea when it's going to open back up, we don't know if we're going to be in business. And that's just, extrapolated across millions and millions of other businesses across the United States. Um, the other question I have to ask is, large portions of the population in the U.S. have no savings. A lot of people, anywhere from 40 to 50% of the people in the country, live hand to mouth. They have no savings, they have no wealth. What do they do if they're laid off for a week or two? What is the plan? I mean, I've heard things that, well, people might have to stay at home till the end of May. Really? Um, how does that work? Where do people where do people get their money? Where do they get their how are they going to survive? And these are questions I think that aren't being fully asked. Everybody's just saying, well, we have to shelter in place, we have to this virus. At some point you have to ask, is the cure worse than disease? This is from the Jim Bianco article that I'm going to reference in a couple slides. In just these past few weeks, the Fed has cut rates by 150 basis points to near zero and run through its entire 2008 crisis handbook. That wasn't enough to calm markets, though, so the central bank also announced $1 trillion a day in repurchase agreements and unlimited quantitative easing. QE eternity is what some people are calling it, which includes a hard-to-understand $625 billion of bond buying a week going forward. At this rate, the Fed will own two-thirds of the Treasury market in a year. Now, we've already seen this type of behavior in Japan and some other uh, central banks around the world, and it hasn't resulted in any inflation. So I'm fearful that central bankers and policymakers may think that they can just print money and buy assets, and it won't have an effect because it didn't have an effect in Japan. We haven't seen inflation. I've had several commenters come on the comment section of this thing and say, well, John, all that money printing didn't cause any price increases. Well, it did cause price increases in asset prices. That's why that asset bubble's deflating. All that malinvestment that was enabled, i.e. in the U.S. shale, i.e. in the renewable business, i.e. cannabis, i.e. Bitcoin and other cryptocurrencies. The zero interest rates and cheap money and low cost debt enabled a lot of malinvestments that are now being unwound. A lot of speculation. I've said this many times, and I'll say it further later on in this discussion this week. Somebody called me the other day and said, well, I just have my money in the bank. What should I do? Well, everybody's been turned to a speculator now. There's no safe haven. And I don't know what to tell people. I don't know what's going to happen. We are basically sailing into uncharted territory. You should read books or stories about the early explorers that came to the New World, like Columbus and some of the Ponce de Leon and some of these other folks. They were just sailing into the unknown. They had no clue what was 10 nautical miles ahead of them. We're basically in uncharted territory like them. And like I said, this is unprecedented what's happening. So this is where I start getting a little bit more worried when we go on and start talking about this. So basically, these are some of the other programs which, commercial paper funding facility, primary market corporate credit facility. This is, buying commercial paper from the issuers directly, buying corporate bonds from the issuer, funding backstop for asset-backed securities, secondary market corporate credit facility, buying corporate bonds and bond ETFs in this, Main Street business lending program. These are things that the Federal Reserve is precluded from doing by legislation. It cannot do this. So what is happening is, to get around this, is that it appears that the Treasury Department is going to set up special purpose vehicles, that they are going to control. The U.S. Treasury can set these vehicles up. They will then, the Federal Reserve will then supply the currency units for the Treasury to buy commercial paper directly from issuers to go into the corporate bond market and support bond prices. This is why I said, somebody asked me about the high yield market. I mean, if the federal government and the Federal Reserve with the unlimited balance sheet is going to come in and buy this high yield junk debt, then we're not going to see a market. We may not see a market clearing event that we were anticipating. So what's happening is, like I said, the Treasury is going to set these special purpose vehicles up. The Fed will then supply just create out of thin air money, and then the Treasury, through these special purpose vehicles it controls, will then be buying these private securities and these debt instruments from companies or from the market. So basically, you are seeing a merger of the Fed and Treasury. This is all going to be administrated by BlackRock, by the way. They're going to, cream off. They're going to be executing a lot of the trades, and welcome your new Federal Reserve Chairman, Donald Trump. Obviously, he controls the administration, controls the Treasury Department. So this is very slick. They now have the Treasury enabled to have access to the unlimited balance sheet that the Fed has, and its ability to create money out of thin air. Now, this is something that the Japanese have been doing. The Swiss, the Japanese central bank pretty much owns the entire Japanese bond market for debt securities issued by the Japanese government, and they have for a long time been in the stock market buying ETFs to support their stock market. Is that something that we'll see the Treasury do or the Fed do? Absolutely. I mean, I think they're going to do whatever is required to plug that. The worst thing that can happen is a prolonged debt deflation and then have a deflationary mindset enter the populace. So, I don't know what's going to happen. I'm just reporting the news. What I'm telling you is that if you think the Fed's balance sheets, made a record last week at 5.2 trillion, you haven't seen anything yet. So the question remains is, how do they unwind this? Bernanke, they did this in 2008 to a limited scale, and it wasn't that publicized. People really didn't know what was going on. And Bernanke unwound it fairly quickly after the crisis was passed. But, I mean, there's going to be the possibility of trillions and trillions of dollars that they're going to have to take on, and I don't know how they unwind it. I mean, at what point does creating money out of thin air become a problem? Is it a $5 trillion balance sheet on the Fed? Is it 10? Is it 40 trillion? I mean, how big is this going to get? And what are the unknown side effects of doing this? We have precluded the market from clearing these malinvestments for decades. So it's kind of like a brush fire. You have these huge brush fires in California that everybody wants to blame on global warming or Pacific Gas and Electric or whatever. And what really happened is mismanagement. There was no brush clearing for years and years. So you build up all this underbrush, this dried tinder on the forest floor that's never cleared, that they never do any controlled burns on. And what happens when you finally get a fire going, it's uncontrollable. And I think, it's analogous to what we're seeing now in the financial markets. We've had decades and decades and decades. You're never allowed to have a recession. No one's ever allowed to experience any pain. Nobody has to be responsible for any of the bad decisions they make financially, whether it's a corporation or, individuals. And so the Federal Reserve will just come in and print money, and then we'll play around here with all these little funding facilities. And we'll just have the Treasury, we'll skirt the law, we'll skirt moral hazard, and we'll just print money. I mean, nobody asked the question, for all these people that are going on unemployment, where's the money coming from to pay for them? The tax base is collapsing along with as the unemployment rate goes up. So real wealth is consumed by these people when they go to the grocery store and take this unemployment check they're going to get, or this $1,200 special check that they're going to get. They're going to go buy real things that were created, that took capital to create, that had to be grown, that had to be transported, that had to be manufactured, and they're just going to buy it with created currency units. And that's not an issue. Meanwhile, the supply of goods is contracting. We're seeing mines shut down. We're seeing businesses shut down. We'll get into that later around uranium, get some announcements there. People are being laid off. Things aren't being produced. At what point, when you create all this money, does it actually translate to goods and service price inflation? Is that coming? There was a lot of moral hazard. Boeing has taken it on the chin. I'll use it as an example. And what we had at Boeing was, the 737 debacle that's going on. And what do we really see? Here's a company that generated billions and billions of dollars of cash flow because it has a good business. It's part of an, two company oligarchy of producing jet airlines with Airbus. So it has pricing power. Aviation demand has been increasing for, because of the emerging markets. And all that cash flow, what did they do with it? They just bought back stock. Why? Because the management at the company was incentivized to get the stock price higher to get their options exercised so that they could personally benefit. It's like Charlie Munger says, show me the incentives and I will tell you the outcome. So instead of having a cash cushion, instead of being prepared, instead of, having like a rainy day fund, nobody does that in corporations, right? Then they've spent all this money on stock prices. They get into this 737 debacle, and now you have a collapse in aviation because of the coronavirus, and now they may need a bailout from the federal government. Why not let the company go bankrupt? The assets don't go away. The brand doesn't go away. The manufacturing facilities don't go away. What goes away is the BS psychopathic board of directors and management that allowed the company to get into this, cutting back on engineering, to cutting back on quality assurance at the factories. It's not just a 737 debacle. I saw an article where a 787, there was a ladder left in the tail stabilizer. Somehow that got left in there. I mean, that could have caused an accident. Everything's cut back so that these people can get their stock options exercised. This is one of the things I do agree with like a person like AOC. Why are we giving bailouts to companies that completely manage their corporations specifically for stock options appreciation? Airlines are the same way. 93% of their cash flow over the last, I don't know how many years, has been devoted to stock buybacks. So you have no rainy day fund, and now, a black swan comes out of left field, and now the federal government's supposed to bail you out. I say let them go bankrupt. And like I said, the assets don't go away. We're still going to need air travel when this thing ends, and new management will come in and run the airlines. If you're going to give these companies bailouts because you want to protect the workforce, then the management's got to go. You can't leave the same management in place. It's that simple. It's the same thing with these trading firms. I said the same thing during the Lehman Brothers thing in 2008. These trading firms should be allowed to go bankrupt. They should be not allowed to be corporations. They should be partnerships so that the partners are taking the risk and they don't get a bailout. You want to put all your wealth on the line and roll the dice, you can do that. But it's the partnership takes the hit, not everybody else in, Peoria, Illinois, or, Des Moines, Iowa. That's not getting any of the benefit. And the news media and both sides of the political spectrum are aligned. That's why you're going to get a Joe Biden on the Democratic side. There's no reformers. The President Trump isn't reforming anything. He's going right back to the playbook. Munchin is a stooge of Goldman Sachs. Why is he in there? He's in there for a reason. And so we're just going to print money out of thin air and bail everybody out again. Okay, I hope it works. I don't know how big can the Fed's balance sheet get? There's $325 trillion in debt around the world. You're going to have, the dollar strengthening because it's a store of value perceived. And so you're having all kinds of dollar shortages around the world with these emerging markets because commodity prices are collapsing. A lot of them are commodity exporters. What happens there? We're just going to bail out the entire world. Is the Fed's balance sheet going to go to $300 trillion? I mean, what is this nonsense of make-believe of not actually producing more than you consume and saving the difference. When is that going to end? I mean, I don't buy into this magic fantasy that you can just continue to operate like this. It defies not only uh, common sense, but economic theory and experience, along with just basic morality. You're basically stealing, you're basically counterfeiting, you're creating something for nothing and then acquiring real goods. You know, this is why everybody poo-poos gold. But if you look at central banks over the last 10 years, they've been net buyers of gold. But they get on there and they slag it off and they poo-poo it, but they're the ones buying the most gold. Why? Because men have to go into the ground and extract it with extreme difficulty. That's why it's being a store of value. You can't just increase the gold supply exponentially like you can these fiat currencies. And that was a limiting factor that kept governments in control because they actually had to expend gold. You couldn't have a welfare state. You couldn't have a warfare state without this fiat monetary system that we have. And most people don't understand that. Now people say, well, this is an emergency, John. Don't you understand? We need to do something. Hey, I don't know what to tell you. I don't know what the knock-on effects of all these responses are going to be. I hope it doesn't turn into, possibly a hyperinflation. Who knows? I'm not saying that's going to happen, but I don't know how bad this is going to get and how long they're going to keep everybody bottled up in their house, producing nothing but yet consuming. So that this is what I was talking about earlier. We're seeing this not only just in the uranium mining sector, but in a lot of other mining and manufacturing operations. Cameco suspends operations at Cigar Lake. This is from the press release. Cameco announced today that it's temporarily suspending production at its Cigar Lake uranium mine in northern Saskatchewan and placing the facility in safe care and maintenance mode due to the threat posed by the coronavirus pandemic. There are no confirmed cases of coronavirus among Cameco's workforce at the present time. The operation will be ramped down over the coming days and placed into care and maintenance for 4 weeks. During this time, Cameco will assess the status of the situation and determine whether to restart the mine or extend the care and maintenance period. So basically, one of the most lucrative uranium mines in the world is being shut down for 4 weeks because of coronavirus. If it's just 4 weeks, is it a big deal? Probably not. But I'm wondering, like a lot of other people are speculating in the uranium FinTwit arena, does this mean that the utilities are finally going to wake up to what the real supply-demand imbalances are? We did see the price of uranium, spot price, has moved pretty decently over the last week since this announcement happened. I think we're up to like $27 or $28 a pound now. And just to say that, I mean, to get back to this, I have to say this, because I've had some correspondence with different people over this issue. Current price of uranium participation corp, which allows you to hold physical uranium, okay, which is basically no risk. I mean, nothing has changed on the supply-demand thesis on uranium because of coronavirus, except this mine suspension. Still building reactors, they're still producing electricity from nuclear power plants. You can buy, as of Friday, shares of uranium participation at a 32% discount to net asset value. Why? Because we're in a liquidity crisis and everything that can be sold needs to be sold when the margin clerk says that your account needs to be reconciled. It's what I've said before in a previous video. Use other people's stupidity and the margin clerk's actions to your advantage. You can buy no risk, low risk uranium in physical form, in UF6 in physical form, being stored in bonded warehouses at a 32% discount to the price, spot price. If you're a uranium investor and you don't see the value in that and you're not buying that, I'm not talking about crappy juniors that may take off. I'm talking about physical uranium. This is a layup trade. If you're not in there buying that, when you have a 32% discount to net asset value, then you shouldn't be in the uranium market. It's just that simple. I mean, you're not going to see bargains like this again. This is like once in a lifetime opportunities. Here's another mine that's suspended operations, Rossing uranium mine in Namibia. I'm not going to read the whole thing, but basically they're going to shut it down for some period of time. Okay. Um, it doesn't really say, I don't think, in the press release when they're going to bring it back online. And I'm wondering if this is just an opportunity and an excuse to further put pressure on by some of these operators on and declare. I've seen in some other businesses where people are trying to use the COVID-19 as a force majeure event. And, why sell your uranium at cheap prices if you don't have to? And if you can just put it on care and maintenance your mine, then declare force majeure into your deliveries. Maybe that's what's going on too. I don't know. Maybe there's an actual genuine concern for the workers. I don't really know what's going on, but I think that this might be a wake-up call for a lot of the um, people in the nuclear industry to start thinking about their supply chain and where they're going to get their nuclear fuel. Want to do the update on the tanker trade. It's working out very nice. Tankers are starting to move now. Late last week, I think we have the most crude now on floating storage as a record. So we have the most crude being stored on tankers ever. Why? Because your demand has collapsed by maybe, we don't know, 10, 20, 30 million barrels a day from the 100 million that's typical a day. And then you have the Saudis and Russians, saying they're going to have this, at least the Saudis saying they're going to pump more oil. It has to go somewhere. So people are leasing tankers and putting it on there. Plus you have trading firms. We talked about the contango, where you can buy oil right now at $23 a barrel and sell it immediately in the futures market for a profit, maybe up to $10 or $11 a barrel higher going 6 months or a year out. And then you just need to find some place to store it and you keep the difference. It's a layup trade. Plus you can finance it with cheap money from these central banks. It's guaranteed free money. So I think it's starting to dawn on people what's happening. And the longer that these shut-ins go in, the more states, more countries that announce that they're going to restrict movement, that they're going to have people shelter in place and get locked down, that's the further demand collapses. And that oil has to go somewhere. You can't just go and shut all your wells off like flipping a switch. You have to throttle things back. You have to take decisions. In some cases, like I've talked about before, you may have some stripper wells, and if you shut them in, you won't be able to restart them. And you can do damage to an oil field if this isn't done correctly. I'm not a petrogeologist, but this isn't as simple as flipping a switch. And once the decision is made, then it cannot be reversed in many cases. What I will say is, though, we are seeing capital expenditures announcements being slashed. Now, I got this off Twitter. It says Permian Basin drillers scaling back. I think a lot of these people operate in the Permian, but this is their overall reductions in Capex. And I mean, this is unbelievable what you're seeing. I mean, Apache's going to cut their Capex this year by 37%. You go down the line, Sentinel Resources, 50%. These are all double digit. Some of these things are, you're in the high 20s, 30% range in all of these. Occidental Petroleum is in big trouble now after, overpaying for Anadarko, slicing the dividend by 86%, capital spending slashed by 32%. These aren't rinky-dink companies. These are big operators. EOG is probably the biggest operator, okay? Slashing Capex by 31%, Diamondback slashing by 41%. So if you don't think this is going to have an effect, what's going to happen now? Our thesis about oil production and not doing enough investment because of shale basically pushing out other non-shale capital spending, which we saw over the last 5 or 6 years. So now we have shale collapsing. I mean, we're going to see some massive decreases in shale production. We have the oil price now in the low 20s. I've seen reports out of Canada that the differentials are so wide now. I mean, it's almost it's unprofitable to ship the oil. Not even unprofitable. You're actually losing money. The price of oil is so cheap in some areas of Canada that when you ship it by rail out, you are in the negative. Okay, and that won't continue. I mean, I could see the oil sands starting to possibly curtail their production. Capital spending is just going to collapse. Sentiment in this industry is going to collapse. I hate to say this, but Valaris, the former Ensco, they're already getting restructuring lawyers lined up. You're going to see massive more bankruptcies in offshore drilling. That's uninvestable at this point. I mean, this black swan got us. I mean, there's nothing to say about it. I mean, was I wrong? Yes, I was wrong because I didn't anticipate that we were going to have a coronavirus come out of left field and shut the world economy down, and then have the crazy Saudis decide to start increasing oil production in the middle of a demand collapse. I mean, it happens. So but like I said, those companies, quite a few of those companies will have to go through restructurings. Equity holders will be wiped out. And then, those rigs don't go away. Somebody will own them. Some other company will be created. Distressed investors will come in and buy them, and then we'll have an ability to play that on the upside. But it's not the time now. I do think, though, that, we will get through this coronavirus. Demand will come back. And, now we have even a bigger gap of no investment going on in Capex. We had the lowest reserve replacement last year, and we only replaced 4% of the oil that we used. We are going to have an oil shock that is going to be something in the next couple of years, is my prediction. I just wanted to point this out, that we are seeing a collapse in the oil Capex. I do think tankers are still a good place to be. So what am I doing? Cash is king. I mean, I've been buying. I was able to catch the downtick in some Australian uranium miners. I mean, I caught the low on a couple of them that I think maybe be the low. I'm continuing to like uranium at these prices. You have to be selective. You have to really understand how you're going to get through to the other side, because there's not going to be any capital available for a while, I don't think. So if your companies need to go out and do offerings, I mean, Denison just did a big offering this week at a very cheap price. That's further dilution, guys. You got to be cognizant of the dilution. There's no reason to be, why not just buy the physical at 32% discount to net asset value if you want to put your money into the uranium market? I mean, when this thing turns around, you will have the opportunity to buy some of these juniors and make a tremendous amount of money. Is this the best time? Only if they have enough, you really understand them, and they have enough cash to make it through, because you're not going to be able to raise money for some period of time. Or if you do, it's going to be at onerous rates, and the dilution is going to be horrible. So I think I like uranium. Physical uranium looks good. I still like gold. I think that we're seeing all kinds of reports that you can't even get gold. A lot of the miners are shutting down. A lot of the refineries are shutting down. The mints are short. That will get rectified. The physical market, I don't think there's going to be some, it's not like they can't get more gold out of the ground. They will. But I think that, depending on how crazy the central banks around the world go, and I wanted to talk about this too. I mean, I always talk about, I think 38 central banks around the world last week cut rates again and have increased their currency production. I mean, if you look at gold and other currencies like the Australian dollar and some other currencies, it's making all-time highs. Okay, and I think it's eventual that the U.S. dollar made an all-time high, but gold's still is still holding in there in U.S. dollar terms. Its turn is coming in U.S. dollars. We're going to see all-time highs in the gold price. As the federal deficit blows out, as money printing, comes into vogue. It just has to happen. I think it's conceivable, if they can get this coronavirus under control, with the amount of money printing and high-powered money that's going to be out there. If this gets under control, you could see it's like a tsunami, right? You just suck all the water out, and you get this false sense that where did all the water go? And then all of a sudden the tsunami comes back in with this huge tidal wave, and it's conceivable that you could see all-time highs in the stock market. Now, it won't be based on economic fundamentals, because the stock market is not based typically on economic fundamentals. It's based on liquidity and sentiment. So I think that you have really some of the worst negative sentiment we've ever seen. No one knows what's going to happen. I certainly don't. I'm just one man with an opinion. But, I think there's pockets where you can make money. Talked about them. Oil tankers and uranium looks good, and I think gold mining shares are eventually going to look good with oil prices at $20 a barrel. I mean, that's one of their largest input costs, but you really need to understand which companies are not closing down, which companies are continuing to mine, and what is going on individually with each company. So lots of stuff happening. You really got to keep up with what's going on. Things are changing on a daily basis. There's information with the coronavirus, amount of infections. But I think we're gonna get headline fatigue here eventually. And I think any bit of good news when this thing eventually does roll over, which it inevitably will, you're going to see some huge relief rallies. You're going to see continued volatility on the upside and downside. But I really think that if you are astute and you can see past this, tremendous values are going to be created. We're going to come out of this. There's going to be a lot of damage. There's going to be some sectors that are uninvestable for a while, but there's going to be other sectors that are getting creamed because baby's getting thrown out with the bathwater. You're going to have a tremendous opportunity, I think, to acquire assets very cheaply. I mean, I'll just say it. I mean, I was buying Paladin last week. I caught it, on a slow tick. It's, rallied already. That doesn't mean it can't go lower. It won't go lower. I'm just telling you that, uranium participation, like I said, 32% discount to net asset value. I think you got to be in there buying if you believe in uranium. So anyway, that's it for this week, guys. Stay safe out there, and we'll talk to you next week. Thank you.